Let us continue the series for investing in stock with preferred stock. Preferred stock is company stock that is issued at a fixed par value, similar to a bond, and that does not confer voting rights but has priority over company earnings when allocating dividends and priority over common stock in bankruptcy proceedings. Preferred stock has characteristics of both common stock and bonds. It occupies an intermediate space between the two in terms of its risk and returns. What is preferred stock and how does it work? The term stock refers to ownership or equity in a firm. There are two types of equity, common stock and preferred stock. Preferred stockholders have a higher claim to dividends or asset distribution than common stockholders. The details of each preferred stock depend on the issue. Key takeaways are, preferred stock is a different type of equity that represents ownership of a company and the right to claim income from the company's operations. Preferred stockholders have a higher claim on distributions like dividends than common stockholders. Preferred stockholders usually have no or limited voting rights in corporate governance. In the event of a liquidation, preferred stockholders' claim on assets is greater than common stockholders, but less than bondholders. Preferred stock has characteristics of both bonds and common stock, which enhances its appeal to certain investors. Let us get an understanding of preferred stock. Preferred shareholders have priority over common stockholders when it comes to dividends, which generally yield more than common stock and can be paid monthly or quarterly. These dividends can be fixed or set in terms of a benchmark interest rate like the London Interbank Offered Rate or LIBOR, and are often quoted as a percentage in the issuing description. Adjustable rate shares specify certain factors that influence the dividend yield, and participating shares can pay additional dividends that are reckoned in terms of common stock dividends or the company's profits. The decision to pay the dividend is at the discretion of a company's board of directors. Unlike common stockholders, preferred stockholders have limited rights, which usually does not include voting. Preferred stock combines features of debt in that it pays fixed dividends and equity in that it has the potential to appreciate in price. This appeals to investors seeking stability in potential future cash flows. There are various types of preferred stock: prior preferred stock preference, preferred stock, perpetual preferred stock, convertible preferred stock, cumulative preferred stock, non-cumulative preferred stock, and participating preferred stock. All of the types of preferred stock are exactly that, preferred stock. However, not all preferred stocks are the same. Each may or may not have different features that make them more or less favorable compared to other types. Prior preferred stock. Prior preferred stock refers to the order in which preferred stock is ranked when considered for prioritization for creditors or dividend awards. Though regular preferred stock and prior preferred stock both hold precedence over common stock, prior preferred stock refers to an earlier issuance of preferred stock that takes priority. For example, if a company can only financially afford to pay one tier of shares its dividend, it must start with its prior preferred stock issuance. Preference preferred stock. Preference preferred stock is considered the next tier of stock in terms of prioritization. Though it falls behind prior preferred stock, preference preferred stock often has greater priority compared to other issuances of preferred stock. If there are multiple tiers of preference preferred stock, each issuance is usually given its rank, such as most senior, second senior, and so on. Perpetual preferred stock. Some types of preferred stock have a fixed end date in which, much like a bond, the original capital contributed is returned to shareholders. In most cases, preferred stock is considered perpetual. This means that the initial capital invested will not be returned. An investor must sell their shares at their choosing to redeem the shares. Convertible preferred stock. In most cases, convertible preferred stock allows a shareholder to trade their preferred stock for common stock shares. The exchange may happen when the investor wants, regardless of the price of either share. Once the exchange has occurred, the investor has relinquished its right to trade and cannot convert the common shares back to preferred shares. Convertible preferred stock usually has predefined guidance on how many shares of common stock it can be exchanged for. Cumulative preferred stock. If a company issues a dividend, it may issue cumulative preferred stock. This means that should a company issue a dividend but not actually pay it out, that unpaid dividend is accumulated and must be made in a future period. It is also important to note that preferred stock takes precedence over common stock for receiving dividend payments. This means that a share of cumulative preferred stock must have all accumulated dividends from all prior years paid before any other lower-tier share can receive dividend payments. Non-cumulative preferred stock. It's worth pointing out that some preferred stock may explicitly state that it is non-cumulative. This means that if a company does not pay a dividend in a given year, that missed dividend is not directly made up for in a future period. Dividends are treated as year-to-year. Any prior period does not carry over and does not hold weight into the order of who gets paid what. This type of stock is common in banking, as there are international rules that dictate how certain capital is classified by regulators. Participating preferred stock. In some years, a company may decide it cannot financially afford to issue a dividend. However, participating preferred stockholders may still be entitled to a dividend. These participating dividends may be tied to company achievements such as total sales, earnings, or specific margins. A participating preferred stockholder may also earn these types of dividends on top of what the company issues as normal dividends, assuming the company has enough finances to make all payments. Preferred stock versus common stock. Preferred stock is equity ownership of a company and is tradable on public exchanges for public companies. Preferred stockholders have the first right to dividends and must be paid before common stockholders. They typically do not have as much capital appreciation and usually have no voting rights. However, preferred stock may have the option to be convertible to common stock and receive better treatment during liquidations. Common stock, on the other hand, is also equity ownership of a company and is tradable on public exchanges for public companies. There is no guarantee of dividends for common stockholders. They must wait until preferred stockholders are made whole. Common stock often has higher capital appreciation and typically comes with voting rights. Common stock does not have the option to be convertible to preferred stock and receives worse treatment during liquidations. While preferred stock and common stock are both equity instruments, they share important distinctions. First, preferred stock receives a fixed dividend as dividend obligations to preferred shareholders must be satisfied first. Common stockholders, on the other hand, may not always receive a dividend. A company may fully pay all dividends even prior years to preferred stockholders before any dividends can be issued to common stockholders. Second, preferred stock typically does not share in the price appreciation or depreciation to the same degree as common stock. The inherent value of preferred stock is the ongoing cash proceeds that investors receive. Common stocks, on the other hand, are more difficult to value. However, because they are not tied to semi-fixed payments, investors hold common stock for the potential capital appreciation. Lastly, the two types of equity have different terms or conditions. Preferred stockholders typically have no voting rights, whereas common stockholders do. Preferred stockholders may have the option to convert shares to common shares but not vice versa. Preferred shares may be callable where the company can demand to repurchase them at par value. Preferred stock also receives better treatment during liquidations. Preferred stock versus bonds. Preferred stock often issues periodic ongoing cash payments. They are issued at par value, which is independent of market value. Dividends may increase, decrease, or end at a company's discretion. Preferred stockholders are behind bondholders during bankruptcy or liquidations and often do not have an end date. Bonds, on the other hand, often issue periodic ongoing cash payments and are issued at par value, which is independent of market value. The interest on bonds is fixed and will not change over the life of the bond. Bondholders receive preferential treatment during bankruptcy or liquidation, and bonds have a fixed term or maturity date. Preferred stock is often compared to bonds because both may offer recurring cash distributions. However, as there are many differences between stocks and bonds, there are differences with preferred equity as well. In terms of similarities, both securities are often issued at face value or par value. This value is used to calculate future dividend payments and is unrelated to the market price of the security. Then, companies may issue dividends similar to how bonds issue coupon payments. Though the mechanism is different, the end result is ongoing payments derived from an investment. There are still many differences between the two. Preferred stock dividend payments are not fixed and can change or be stopped. However, these payments are often taxed at a lower rate than bond interest. In addition, bonds often have a term that matures after a certain amount of time. There is theoretically no end date to preferred stock. In addition, there are considerations to make regarding the order of rights should a company be liquidated. In most cases, debt holders receive preferential treatment, and bondholders receive proceeds from liquidated assets. Then, preferred shareholders receive distributions if any assets remain. Common stockholders are last in line and often receive minimal or no bankruptcy proceeds. Companies in distress. If a company is struggling and has to suspend its dividend, preferred shareholders may have the right to receive payment in arrears before the dividend can be resumed for common shareholders. Shares that have this arrangement are known as cumulative. If a company has multiple simultaneous issues of preferred stock, these may in turn be ranked in terms of priority. The highest ranking is called prior, followed by first preference, second preference, and so on. Preferred shareholders have a prior claim on a company's assets if it is liquidated, though they remain subordinate to bondholders. Preferred shares are equity, but in many ways, they are hybrid assets that lie between stock and bonds. They offer more predictable income than common stock and are rated by the major credit rating agencies. Unlike bondholders, failing to pay a dividend to preferred shareholders does not mean a company is in default. Because preferred shareholders do not enjoy the same guarantees as creditors, the ratings on preferred shares are generally lower than the same issuer's bonds, with the yields being accordingly higher. Important to note, cumulative preferred stock has the condition that any previously awarded dividends that have not yet been paid must be distributed before any common shareholder receives any dividend distribution. This is in contrast to non-cumulative preferred stock, which does not accumulate prior unpaid dividends. Voting rights, calling, and convertibility. Preferred shares usually do not carry voting rights, although under some agreements, these rights may revert to shareholders who have not received their dividend. Preferred shares have less potential to appreciate in price than common stock, and they usually trade within a few dollars of their issue price, most commonly $25. Whether they trade at a discount or premium to the issue price depends on the company's creditworthiness and the specifics of the issue. For example, whether the shares are cumulative, their priority relative to other issues, and whether they are callable. If shares are callable, the issuer can purchase them back at par value after a set date. If interest rates fall, for example, and the dividend yield does not have to be as high to be attractive, the company may call its shares and issue another series with a lower yield. Shares can continue to trade past their call date if the company does not exercise this option. Some preferred stock are convertible, meaning they can be exchanged for a given number of common shares under certain circumstances. The board of directors might vote to convert the stock, the investor might have the option to convert, or the stock might have a specified date when it automatically converts. Whether this is advantageous to the investor depends on the market price of the common stock. Here is a tip: pay attention to whether a preferred stock is callable. Who are typical buyers of preferred stock? Preferred stock come in a wide variety of forms and are generally purchased through online stockbrokers by individual investors. The features described above are only the more common examples, and these are frequently combined in a number of ways. A company can issue preferred shares under almost any set of terms, assuming they don't fall afoul of laws or regulations. Most preferred issues have no maturity dates or have very distant ones. Institutions are usually the most common purchasers of preferred stock, especially during the primary distribution phase. This is due to certain tax advantages that are available to them, but that are not available to individual investors. Because these institutions buy in bulk, preferred issues are a relatively simple way to raise large amounts of capital. Private or pre-public companies issue preferred stock for this reason. Preferred stock issuers tend to group near the upper and lower limits of the creditworthiness spectrum. Some issue preferred shares because regulations prohibit them from taking on any more debt, or because they risk being downgraded. On the other hand, several established names like General Electric, Bank of America, and Georgia Power issue preferred stock to finance projects. There are advantages of a preferred stock. What are the advantages of a preferred stock? A preferred stock is a class of stock that is granted certain rights that differ from common stock. Namely, preferred stock often possess higher dividend payments and a higher claim to assets in the event of liquidation. In addition, preferred stock can have a callable feature, which means that the issuer has the right to redeem the shares at a predetermined price and date as indicated in the prospectus. In many ways, preferred stock share similar characteristics to bonds, and because of this are sometimes referred to as hybrid securities. Who buys preferred stock? Preferred stock often provides more stability and cash flow compared to common stock. Therefore, investors looking to hold equities but not overexpose their portfolio to risk often buy preferred stock. In addition, preferred stock investors receive favorable tax treatment. The company issuing the preferred stock does not receive a tax advantage, however. Institutional investors and large firms may be enticed to the investment due to its tax advantages. What is an example of a preferred stock? Consider a company is issuing a 7% preferred stock at a $1,000 par value. In turn, the investor would receive a $70 annual dividend, or $17.50 quarterly. Typically, this preferred stock will trade around its par value, behaving more similarly to a bond. Investors who are looking to generate income may choose to invest in this security. The most common sector that issues preferred stock is the financial sector, where preferred stock may be issued as a means to raise capital. Can you lose money on preferred stock? Like any other type of equity investment, there are risks of investing, including the loss of capital you invest into the company. Preferred stock have specific features different from common stock, so they may perform differently. However, both investments are reflections of the performance of the underlying company. Should the company begin to struggle, this may result in a loss or decrease in value in the preferred stock price. Just as there are advantages of preferred stock, there are also downsides or disadvantages. What are the downsides or disadvantages of preferred stock? Though preferred stock often has greater rights and claims to dividends, this type of investment often does not appreciate in value as much as common stock. In addition, preferred stockholders have little to no say in the operations of the company, as they often forego voting capabilities. Here's the bottom line. Investors interested in generating cash flow from their equity holdings may be better suited to holding preferred equity or preferred stock. This type of equity investment represents ownership of a company and results in prioritized treatment for dividend distributions. Though there are sacrifices for this right, preferred stock is simply a different vehicle for owning part of a business. Before we continue, we hope you are gaining value from this information. If so, do not forget to subscribe to show appreciation for the insightful content. Hit the like button to assist yourself and others in the learning process, and ensure you activate the notification bell to stay updated with the latest valuable additions to this series. Our aim is for you to gain valuable information from this video. If you are, just take 2 seconds, 1 to subscribe and 1 to like this video. It means a lot to us. Thanks. Now let us continue. Floating stock. What is floating stock? Floating stock is the number of shares of stock a company has that are actively being traded by the public. It is generally referred to as float. It is the number of shares available for trading of a particular stock. Low float stocks are those with a low number of shares. Floating stock is calculated by subtracting closely held shares and restricted stock from a firm's total outstanding shares. Closely held shares are those owned by insiders, major shareholders, and employees. Restricted stock refers to insider shares that cannot be traded because of a temporary restriction, such as the lockup period after an initial public offering, or IPO. A stock with a small float will generally be more volatile than a stock with a large float. This is because with fewer shares available, it may be harder to find a buyer or seller. This results in larger spreads and often lower volume. Key takeaways are: floating stock refers to the number of shares a company has available to trade in the open market. To calculate a company's floating stock, subtract its restricted stock and closely held shares from its total number of outstanding shares. Floating stock will change over time as new shares may be issued, shares may be bought back, or insiders or major shareholders may buy or sell the stock. Low float stocks tend to have higher spreads and higher volatility than a comparable larger float stock. Investors can find it difficult to enter or exit positions in stocks that have a low float. How to understand floating stock. A company may have a large number of shares outstanding but limited floating stock. For example, assume a company has 50 million shares outstanding. Of that 50 million shares, large institutions own 35 million shares, management and insiders own 5 million, and the Employee Stock Ownership Plan (ESOP) holds 2 million shares. Floating stock is therefore only 8 million shares, 50 million shares minus 42 million shares, or 16% of the outstanding shares. The amount of a company's floating stock may rise or fall over time. This can occur for a variety of reasons. For example, a company may sell additional shares to raise more capital, which then increases the floating stock. If restricted or closely held shares become available, then the floating stock will also increase. On the flip side, if a company decides to implement a share buyback, then the number of outstanding shares will decrease. In this case, the floating shares as a percentage of outstanding stock will also go down. A stock split will increase floating shares, while a reverse stock split decreases float. Why floating stock is important? A company's float is an important number for investors because it indicates how many shares are actually available to be bought and sold by the general investing public. Low float is typically an impediment to active trading. This lack of trading activity can make it difficult for investors to enter or exit positions in stocks that have limited float. Institutional investors will often avoid trading in companies with smaller floats because there are fewer shares to trade, thus leading to limited liquidity and wider bid-ask spreads. Instead, institutional investors, such as mutual funds, pension funds, and insurance companies that buy large blocks of stock, will look to invest in companies with a larger float. If they invest in companies with a big float, their large purchases will not impact the share price as much. Consider this: a company is not responsible for how shares within the float are traded by the public. This is a function of the secondary market, which will be discussed in our next chapter. Therefore, shares that are purchased, sold, or even shorted by investors do not affect the float because these actions do not represent a change in the number of shares available for trade. They simply represent a redistribution of shares. Similarly, the creation and trading of options on a stock do not affect the float. Here is an example of floating stock. As of September 2023, General Electric (GE) had 1.088 billion shares outstanding. Of this, 0.20% were held by insiders, and 75.81% were held by large institutions. Therefore, a total of 76% or 830 million shares were likely not available for public trading. The floating stock is therefore about 260 million shares, 1.088 billion minus 830 million. It is important to note that institutions don't hold a stock forever. The institutional ownership number will change regularly, although not always by a significant percentage. Falling institutional ownership coupled with a falling share price could signal that institutions are dumping the shares. Increasing institutional ownership shows that institutions are accumulating shares. Is floating stock good or bad? Well, stock float isn't good or bad, but it can affect an investor's decisions. The amount of floating stock a company has, the shares made available to trade, can affect the liquidity of that stock. Stocks with a smaller float tend to have high volatility, while stocks with a larger float tend to have lower volatility. Some investors may prefer stocks with higher float because it's easier to enter and exit positions for these stocks. What is stock flotation? Well, stock flotation is when a company issues new shares to the public. It can help the company raise capital. The opposite of stock flotation is a float shrink, such as with stock buybacks. Fewer shares are available to trade. What is the difference between floating and non-floating shares? The floating shares are the shares available to trade, while non-floating shares are those held by shareholders and company insiders and are not available for trading. What is the bottom line? A company's floating stock is the shares it has available to trade on the open market. Traders tend to prefer stocks with larger floats, as they find it easier to enter and exit a stock that has greater liquidity. Stocks with larger floats have more shares available, making them more liquid and easier for investors to buy or sell. As we close this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but a huge support for us, and it is completely free. Please join us in our next chapter as we discuss secondary offering, fractional shares, and equity compensation.